Hi, welcome to Crypto Made Easy. Today I want to talk about futures trading on Binance, the how to do it correctly. So in today's lesson we'll be talking about what futures contract is, the various types. We'll also talk about the various products that are available on the Binance Futures platform. Talk about the differences between sports trading and futures trading. We also talk about margin, the different margin modes and what they mean and how to use them correctly. Then we'll talk about leverage and its implication in the use or the implication of using leverage in futures trading. And then from there, we'll talk about various types of orders that are available on the Binance Futures platform. Okay, so if this are the things that you want to learn about, I encourage you to stick around and watch this video to the end. And please like this video so that you make it favorable to the YouTube algorithm to show it to more persons who will benefit from the knowledge shared in this particular video. And if this is your first time of joining my channel, kindly subscribe so that you not miss future videos that are useful like this one, which I'll be dropping from time to time on this particular channel. Okay, so with that said, let's get straight to it. First of all, before I go on to the derivatives where you're going to see the Binance futures options and all the products that are available, first of all, let's talk about what futures contract is and what it means for you as a trader on Binance platform. So futures contract is basically an agreement to buy or sell an asset at a future date at an agreed upon price. That is, it is an agreement that you're going to sell a particular asset at a particular price that two parties agree upon today at a time in the future. Now, usually in commodity trading, futures contract is used to protect against price swings, which happens a lot in commodity trading. So, as a commodity trader, what you want to do is to agree upon the supply or the supply of a particular product in the future, but at a price that you and the other party agree now, so that even if the price changes, maybe the price increases or the price decreases, the fluctuations in price will not affect the contract that both of you have already entered into. So that is basically what futures trading is with regards to commodity trading. But here we're not trading commodity, we're trading derivatives. That is, we are basically making speculations on the price movement. So in futures trading, you're allowed to take a position on the direction of movement of price, okay, of a particular asset. So in futures trading, you can say you can make profit whether the price goes up or the price comes down, depending on the position that you take upon that particular asset's price movement. Okay, so let me quickly go over to derivatives and show you the various products that we have under Binance Futures. Okay, so here we have the stable coin margin futures, we have coin margin futures, we have vanilla options, leverage tokens, and battle. So basically, I want to consider the stable coin margin futures and then the coin margin futures and look at what the differences are between them. Okay, so basically the stable coin margin futures allows you to use a stable coin as the asset. Okay, so a stable coin is the asset that will be used to settle that particular contract, whereas a coin margin futures uses a cryptocurrency, in which case we're talking about Bitcoin. Okay, so the stable coin margin futures uses USDT, that is US Tether, and then the coin margin futures uses Bitcoin. So that is basically the difference between the US stable coin margin futures and coin margin futures. Now, why would you want to pick to choose coin margin stable coin margin futures over coin margin futures? Now, you know that stable coins are stable by virtue of the fact that they are backed by the US dollar, and the price of stable coins are usually kept to be around the US dollar. Okay, so the price doesn't fluctuate much, and that gives you stability in your position in futures trading. If you use coin margin futures, you are going to be using BTC as the underlying asset. Okay, and if you use BTC as the underlying asset, if the price of BTC drops, it is going to affect the your margin, which may result to you being liquidated far earlier than it should have been. Okay, so that is why personally I would recommend that you use a stable coin margin futures. Now, under stable coin margin futures and coin margin futures, we have two types of futures that are available. We have the perpetual futures contract, and then the delivery futures contract. Okay, so basically perpetual contract allows you to take a position continuously, perpetually, without an end, whereas a delivery contract has a specific delivery date. Usually it is quarterly. So if you are taking a delivery futures contract, you know that if you're taking a position in delivery futures contract, you know that that particular position is going to come to an end at a particular time in the future, say in 3 months time or in 6 months time. Whereas if you are using the perpetual futures, you are allowed to keep your position open for as long as you have the margin required to keep it open. Okay, so basically that is the difference between the perpetual futures contract and the delivery futures contract. And then both of them have the same leverage, they have the same um, amount of leverage available to them. So we'll go on to talk about the differences between spot trading and futures trading, just so that you know why you should go into futures trading in the first place, or why you shouldn't go into futures trading in the first place. So one of the differences between futures trading and spot trading is that in spot trading you're buying the underlying asset. That is, you're buying, for example, if the asset you're trading is Bitcoin, in spot trading you're buying Bitcoin, and then the Bitcoin you buy or sell, the Bitcoin you buy, let me use buy in this scenario, the Bitcoin you buy will be yours. It will be kept in your wallet. Now, whatever happens to the price of Bitcoin, you will still have that amount of Bitcoin that you bought. Okay, so if you bought, say, one Bitcoin, then if the price of Bitcoin drops, you still have one Bitcoin in your wallet. The only thing that will change is that the worth of that one Bitcoin may have dropped, but you still have one Bitcoin. Whereas in futures trading, you're not buying the underlying asset. Rather, you're taking a position on the price movement. You're saying, okay, I am speculating that the price of Bitcoin is going to rise. And so when the price of Bitcoin rises, you make gain, you make profit based on that position you've taken. Okay, and if you're selling, you are saying that the price of Bitcoin is going to drop, and as long as the price of Bitcoin continues to drop, you are making profit. And if the price goes up against your position, then you're making a loss. So one of the fundamental differences between spot trading and futures trading is the fact that in spot trading you're buying the asset, whereas in futures trading you are not buying the asset. Rather, you are speculating, you are taking a position on the price movement. Then another difference is that while in spot trading you only make money when the price of the underlying asset that you bought increases, and then you sell higher than you bought. That is when you make profit in spot trading. But in futures trading, you can make profit both ways depending on your position. So you can make profit when the price of Bitcoin is rising, and you can also make profit when the price of Bitcoin is dropping, depending on the position that you take. Okay, so that is another difference. And then in spot trading, that's the third difference. Now, in spot trading, there is no leverage. Okay, in spot trading, there is no leverage. You don't have this leverage here opportunity. You don't have this leverage here in spot trading, but in futures trading, you have leverage. And I'm going to explain more about leverage and how to use it in this particular video. Okay, so another difference is that in spot trading, you usually will not be liquidated no matter what happens to the price of the coin of the underlying asset. You're still going to have that asset in your wallet. Even if the monetary value is zero, you're still going to have that particular asset in your wallet. Whereas in futures trading, you can be liquidated if you don't have if your the margin you have is below the maintenance margin level, you are going to be liquidated. So you see that futures trading carries more risk for you as a crypto trader because of that possibility of being liquidated if you don't have the required margin. Okay, then lastly, futures prices are usually different from spot trading prices. Of course, the prices may converge at a point in the future on the long run, but in short term basis, the price of the particular asset you are trading on futures may be slightly different from the price of that particular asset on spot trading. Okay, so having known some of the differences between spot trading and futures trading, let's go on to explore some of the various features of futures trading and how to use them correctly. Okay, so I talked about futures trading having two modes. We have two margin modes, and then we have the cross margin, which is this. So you can click on cross, and then you have the option of choosing between cross margin and isolated margin. Okay, now basically cross margin allows you to pull to use one margin for all your open positions, and then if one of your positions requires more margin, then the more margin can be gotten from the other open positions or from the entire account to keep that particular position open. But in isolated margin, you are having the margin that you assign to that particular position is the only margin that will be used to keep that position open. If you run out of margin and your account needs to be your position needs to be liquidated, only that one position is going to be liquidated. Whereas in cross margin, you have the entire positions being managed by one particular central margin. Okay, so when one position gets liquidated in cross margin, all the other open positions will be liquidated. But in isolated margin, when one position is liquidated, the other open positions will not be affected. So okay, so if you want to trade futures, one of the first things you want to decide is whether to use a cross margin or to use isolated margin. Now, which one you use depends on your what you decide concerning your trade. Okay, if you're having a lot of open positions, you may want to use isolated margin to make sure that what happens in one particular position does not affect the others. But if you're having basically just one open position, then there is no difference between cross margin and isolated margin in that particular regard. Okay, so let's say we're going with isolated margin for the purpose of this training. Okay, so once you've selected that, you can confirm, and then you're already you've set the margin. Then we'll talk about leverage. Now, I said that leverage is available in futures trading. What leverage does is that it allows you to spend more money than you have. Okay, so with leverage, let's say you have just 10 USDT, you can use leverage so that you're able to spend more than you have. So if you're using a 20x leverage, then basically you're saying that if you have 10 USDT, you're allowed to spend 10 times 20, as in 20 times the amount of USDT that you have. And that's why you're having 20x or 20 times, as the case may be in this particular case, in this particular margin leverage, sorry. So you can decide to adjust the leverage to increase it, or you can simply use the slider here to select or reduce the amount of leverage that you want to use. So now leverage helps you to make more money. If you use leverage, you you have the potential to make more money than you would have made if you didn't use any leverage. Now, 1x leverage simply means that you are not using any leverage, because uh, the amount of coins you have is the amount that you'll be able to use to trade with. So if you have 10 USDT, then 10 USDT is the only amount of coins. It's only 10 USDT worth of coins that you can buy or sell on futures trading. But if you use 25x or use 10x, as the case may be, you're multiplying the amount of coins you can buy with that particular 10 USDT. So the the higher the leverage that you use, the more the risk. And that's why you see a warning here: your leverage is high. Please manage your risk accordingly. Now, the higher the leverage, the higher the risk. Why is it so? This is because the higher the leverage, the lower the amount of price change that is required to liquidate that particular position. Let me show you a quick graphic representation of what I'm saying here. So if, let's say, I am here, okay, now this is it. The lower the leverage, the higher the percentage price change for liquidation to occur. Okay, so if you're using 1x leverage, you need 100% change in price before that particular position can be liquidated. Okay, so if you're using 5x leverage, then a 20% change in price is enough to liquidate that particular position. If you're using 20x leverage, you have 5% change in price is what is required to liquidate that particular position. So from here you can see that the higher the leverage, the lower the percentage change in price required for liquidation to occur. So if you're using 100x leverage, for example, then only 1% change in price is enough to liquidate that particular position. So you see why you should not be using a very high leverage, because with high leverages you have the lower, or should I say the higher your chance of liquidation, because any little change in price, and changes in price occur a lot in cryptocurrency trading. So if you're using a high leverage, then just a little change in price is enough to liquidate that particular position. And just in case you are new to crypto trading, when I say liquidate that particular position, I'm saying that you're potentially going to lose the amount of coins you have put into that trading, as you are going to lose the margin, you're going to lose the collateral you put in for that particular trading. So what I would recommend is that you should use a leverage not more than 10x leverage. 10x leverage, not more than 10. Even 10x leverage is quite high, because you can see a price a fluctuation that will be more than 10% in terms of um, price changes. So 20x leverage will have 5%. There will be a 5% change in price. Will see your position liquidated. So you should stay somewhere around 5x leverage and 10x leverage, so that your position will stay open longer and you'll be able to make the gain you want, and then close your position when you see that the price of that particular coin is going against you. So I recommend you should not use more than 10x leverage. Even for optimal gain, you should be staying somewhere around 5x leverage. Now, many people lose a lot of money when they use high leverages. Of course, high leverages gives you the opportunity to make more money, but then it also has the risk of losing all your money. Okay, so you want to always use a very low leverage. So, but before you get started, you need to have collateral. Okay, so what you do, you come over to this point here, to this arrow, click on it, and you'll be able to transfer USDT from your spot wallet to your futures wallet, to your stable coin margin futures wallet. Okay, so once all you just have to do is put in the amount of USDT that you want to transfer, and then you confirm. Okay, so once you've done that, then you now have the leverage required to make to take positions in futures trading. So for emphasis, I said that if you're buying, you are simply saying that you are expecting the price of that particular coin to rise, and if the price of that coin rises, then you'll make profit. And if you're selling, or if you go short, as the case may be, it means that you're saying that the price of that underlying asset is going to drop. And when the price of that asset drops, you make profit. So if the price goes against you, then you know, of course, that you're making losses. And if you are using leverage, your profit or loss, like I said previously, is going to be multiplied by the amount of leverage that you use. So if you're using 20x leverage and you're making a 1% gain, that means your profit is going to be multiplied by 20. So you're making 20% profit. And if you are losing, that means a 1% change in price, a 1% profit is going to be multiplied by 20, which is the amount of leverage you have selected, and then you're making a 20% loss. Okay, so that is how it works. So let's talk about some settings you want to do before you go on to the various other types that we have. So what you want to do is go over to this point, and then you'll be able to check out the preferences. Okay, so the preferences here, you want to set your order confirmation. You can decide to turn this on, okay, so that a page will be shown to you to confirm your order before it will be placed. If you turn them off, if you place your order, there will be no confirmation. There will be no confirmation page. It will just go on straight away. So you can decide to turn on or turn them off as the case may be. So the position mode here, you're allowed to change between one-way mode or the hedge mode. Now, in one-way mode, one contract can only hold positions in one direction. In other words, with one-way mode, you are only allowed to hold positions, say to take a buy position or a long position or a short position. But in hedge mode, you can go both ways, either to go long or to go short, as the case may be. So you want to choose between one-way mode or hedge mode, and then you come over to price protection. So price protection uh, allows you to to protect the price against unfavorable fluctuations that happen in the price. So basically, if the difference between the last price and the mark price of the contract exceeds the set threshold, when the stop loss or take profit orders reach the trigger price, the stop loss or take profit orders will not be triggered. So basically, this allows you to protect yourself from excessive loss or excessive loss basically. So you may want to turn that on if you choose, or you can decide to turn it off, whichever way. You have to confirm your selection. And then notifications, would you want to be notified of take profit or stop loss trigger when the limit is up to 25, that is when the limit for the number of notifications you can have is 25 per day. So you may want to turn that on or turn it off depending on your preference. Sorry. So you also have the asset mode, where you have the single asset mode, which supports uh, the stablecoin margin futures trading, where you have profit and loss of the same margin asset positions can be offset and all that. So you have the multi-asset mode here. You can decide to choose between these two positions, and whatever your choice, you click confirm, and then you're done with that. Okay, so now that you've set your preferences, let me talk about grid trading before I go on to talk about the types of orders. So grid trading basically allows you to is grid trading is more of an automated kind of trading, whereby you are allowed to set positions, to open a position that to go long or go short, and then you are able to set it up so that a certain number of positions will be open for you. Okay, so let's say if you're taking a buy, a long position, in which case you are buying, you can set the number of grids that you want. Let's say 20. So what happens is that if you set in 20, what happens is that this you're going to have 10 open positions for buy and 10 open positions for sell. So basically, it allows you to have different entry points into the trade. Okay, as long as so you're having entry points, like, let's say the price currently is 41,000, let's say 41,300. Okay, so with grid trading, you're going to have a buy position at 41,300. You have another buy position at 41,320, and so on. So you have different buy positions, and at the same time you have different corresponding sell positions so that you're able to trade within a particular interval, so that as the price is rising and dropping within that range, you're buying and selling uh, within that particular range. So that is the use of grid trading. You can take either long or short positions with grid trading. So back to our the trading platform here, we talk about the various orders where we have the limit order, we have market order, we have stop limit, we have stop market and trailing stop, and then post only orders. Okay, so limit order basically allows you to put in the limit price and then the size of the asset you want to buy, and you take your position whether buy that to go long or to go short. Okay, so basically that's how limit order works. It allows you to buy at a particular price or at a price better than that as the limit price that you have set for that particular order. The market order allows you to buy at the market price. So in market order, all you have to do is to put in the amount of coin that you want to buy or sell, and then you take a position, you place an order, and that order will be executed at the market price. Then we have stop limit. Stop limit allows you to put a stop price, and here you can choose between mark price or last price. Okay, so if you put a stop limit here, once the stop price is reached, then a limit order is triggered. Once the stop price is reached, a limit order is triggered. So you can put a stop price that when the price of BTC falls down to 40,500, then a limit order should be placed to buy BTC at for 40,000. Okay, so basically that is how it works. So once the price of BTC, once the market price of BTC gets to this particular price, which is 40,500, then your order to buy at 40,000 dollars will be placed, and then all you have to do is put in the size of BTC that you want to buy, and then you take your buy position. And if you want to sell the same way, you just click on sell or you go short. Okay, so we have, apart from the stop limit, you also have the stop market. So in stop market, basically all you put in, you don't have a limit price, all you have to put is a stop price. So once the price of the asset gets to that particular stop price, then a market order will be triggered. So once the price of that asset gets to that stop price, then that as you are going to buy a particular amount of assets, or you're going to sell a particular amount of assets at the price at the market price at that particular point in time. So that is the difference between stop limit and stop market. Stop limit triggers a limit price when the stop price is reached, while a stock market triggers a market order, sorry, when a stop price is reached. So trailing stop allows you to kind of lock in profit. Okay, so trailing stop order allows you to lock in profit by enabling a trade to remain open and continue uh, as long as the price is moving in the direction favorable to traders. So when the price moves against, as in when the price moves in the opposite direction, the trail stops and the position is closed. So basically what happens here is this. Let's say you're taking a long position at say 40,000. What's the market price now? Okay, 40,200. Okay, so if you're taking a long position at 40,200, and sorry, 41,200, and then the price of the market is moving in your favor, what is going to happen is that if you put a callback rate here, which you can choose any particular percentage, let's say 1%. So when you choose a callback rate and you put an activation price here, what happens is that, well, as long as the price of Bitcoin is moving high, your you are going to, and you put in the size, definitely. So as long as the price of Bitcoin is moving in the favor that is favorable to your position, whether a long position or a sell position, a trailing stop order will allow you to keep to remain in the market, but with the trailing adjusting as the price is going up. So let me explain further that if you have a call rate of 1%, so as long as the price is moving upwards, once the price moves over, or when the price reaches 1% gain, when you have made 1% gain, then a new trail will be set up, a new activation price will be set up, so that one if the price goes against you, then you are able to sell off and then take profit, so that you don't lose all that you have already made. So as you just put in your callback rate here, and then the activation price, the size of the asset you want to buy or sell, and then you take your position. Okay, so basically that is how to trade a Binance Futures. So if you take your position there, these are you'll be able to see your position here, where you have the size, the entry price, the mark price, we have the liquidation price here, and we have the margin ratio here, we have the margin, okay, and you have your profit and loss, which will be in a percentage, and then you can close your position here. Okay, so I didn't explain the post only order. The post only order allows you to just post an order that will be added to the book, but will not be executed with a pre-existing order immediately. So that is the post only order. And then with that, you can also have what we call the limit, take profit or stop loss order. Okay, so if you with that limit, take profit or stop loss, you can use a stop loss or take profit order here, so that if the price is moving in your favor, you take profit at a particular point, and if it is moving against you, you put in the stop price here, so that if the price is moving in your favor, you can take profit at a particular point. Let me demonstrate that. The price of BTC here is 41,505. Okay, so you can say, let's say you're buying 0.1 BTC. Okay, you're buying 0.1 BTC, and then your leverage is 20x, and you want to say, okay, let me say, if the price of BTC increases, let's say we are taking a long position now. So if the price of BTC increases to say 42,300, then you should sell off. You should take your profit and then sell off at that particular point in time. That is, you close your position. Then, but if the price of BTC drops to say 40,500, now in which case you are losing, you are making a loss, then you should stop loss and close your position at that particular point. So all you have to do is to select your preferred position, whether to buy or go long, or to sell or go short. So basically that is how the limit, take profit or stop loss order works. And if you are taking a short position, then what you want to do is to put a a price that is lower than the limit price here, So let's say you're hoping that the price of BTC will drop to 39,500, and then that is the take profit mark. Okay, that's the price that at which you want to close your sell position. So once the price gets to 39,500, when the price falls to 39,500, your position will be closed and you take profit. But if the price, instead of falling, rises to say 42,000, then you can stop your loss at that point to avoid being liquidated. Okay, so you just take your stop your position, which is to sell short. So once you've done that, all your positions, you'll be able to see them here, and you'll be able to close your position at any point in time. So you see your margin ratio, and the liquidation price, which is the price that once the price of of the coin gets to your asset, is going to be, your position will be liquidated and you will lose your margin that you put in for that particular trade. Okay, now let's say we are using this particular example, we're buying 0.1 BTC. I want to go long on 0.1, okay, sorry, I want to go short on 0.1 BTC at this particular price. Then this is what it will cost me to open this particular position. To open this particular position, it's going to cost me 207.52 USDT. Okay, so that is what it will cost. And now I can't do that because I don't have what, I have not put in collateral. So what I want to do first of all is to go here and transfer money from spot uh, wallet to the futures wallet, so that I will have enough margin to take this particular position. And with that, that is basically how to trade futures on Binance. And you can come over here and then select the particular asset you want to trade. So these are the all the assets you can trade, can take a position on. And once you've seen the particular asset you want to trade, all you have to do is select it, and then you are done with that. Make sure you always do your technical analysis before taking a position in spot trading, because without technical analysis you are bound to make a whole lot of losses in futures trading. And like I said previously, always use a very low leverage level, okay, so that you do not get liquidated easily and you're able to make profit. And and then, or you can even stop your loss quite easily when you use low level of leverage. So basically that is how to trade on futures. Of course, you know about other, if you've not watched, if you watched my previous video on spot trading, you know about the other book and all that. So basically, this is how to trade on trade Binance Futures. And you can also do this on your mobile application. You don't need to go to have a laptop before you can trade Binance Futures. So everything I explained here, you can have them, you can find them in your Binance application. Okay, so if you watched this far, kindly like this video and subscribe to my channel if this is your first time, so that you have access to more useful videos such as this. Thank you, and enjoy yourself trading Binance Futures.